and welcome to the first episode in our series on Boardroom Forum Live that's really focusing on accounting and financial reporting. My name is Shreeya Jugnandan, an Associate Director at PwC's Corporate Reporting Services. And joining me for this very special first episode is Nitassha Somai, a partner in Corporate Reporting Services. Welcome to Boardroom Forum Live, Nitassha.
Thank you, Shreeya, and thank you for the opportunity to be here.
I'm so excited to talk to you about this topic. So what we're covering this morning deals with something that is linked to a global economic phenomenon, really elevating the concepts of financial reporting and coupling it with interest rate reforms. So globally, we've seen replacements of really key interest rates, such as LIBOR, which was once referred to as, I think, the most important number in the world, residing within a number of critical contracts for both financial and non-financial services entities. Nitassha has a wealth of experience in dealing with complex financial reporting matters, irrespective of the sector of the underlying entity. Nitassha, given these global developments and interest rate reforms, can you really guide us through what's happening from a local South African perspective?
Thanks, Shreeya. As you can imagine, anything that's interest related is a hot topic just because of interest impact on the general environment. Like you mentioned earlier, there has been a significant global reform with regards to interest rates, and as a result, we've seen a number of international IBOR-linked rates being amended. And as a result, the South African Reserve Bank here has decided to also undertake a similar project to assess whether JIBAR is actually still fit for purpose. When I refer to JIBAR, it's the Johannesburg Interbank Average Rate. And I think that the biggest issue with the IBOR rates was a concern raised by the Financial Stability Board. And the concern was that there was manipulation or potential for manipulation in these rates. And as a result, there was a question around its integrity as well as reliability. So the South African Reserve Bank then decided, well, in line with international global best practice, it's time to relook whether JIBAR is still fit for that purpose, and as a result, embarked on this project. And that brings us to where we are now. So Zaronia, although it sounds like a very fancy gemstone, is the replacement rate for JIBAR. So it was in November of 2023, so last year, that the Reserve Bank actually announced that contracts can now be priced in Zaronia. And at the same time, well, in May of this year, the Market Practitioners Working Group, which is essentially a group put together to undertake this project, set out the transition plan and the roadmap for transitioning to Zaronia. And I think we focused, or there's three key takeaways for us from that publication. The first is that JIBAR will cease at some point in time. The expectation for now is the end of 2026. Although that seems like it's still far, we know that time moves very quickly. And what does JIBAR cessation actually mean? Well, at that point, JIBAR will no longer be published. So if you have a contract which references JIBAR, you are going to have to change that contract to an alternative reference rate. So I think that's point number one. The second point is for a period of time, there will be parallel rates, meaning that JIBAR will run at the same time together with Zaronia. And this is just to help the market to transition to the new rates and really just give them the time to be able to do this. Because as you can imagine, this is going to be a significant project. And I think the third point for us is the Dear CEO letters, which will be sent from the second half of 2024, which is the point at which we are now. And this letter is essentially going to be sent from the SARB to the CEOs of various companies, which sets out their expectation for JIBAR transition. And I think for what you can expect to see is that the transition is broadly going to be broken down into three pillars. The first being derivative contracts, the second being cash contracts, and then the third being your legacy contracts.
Thanks, Nitassha, for those interesting remarks, no pun intended, in terms of what's going on in our local economic landscape. Let's take that a step further and really appreciate the immensity of what's happening here. We have an interest rate that I'm sure a number of contracts refer to that is no longer going to be published. What are some of the first steps preparers should be thinking about when it comes to this transition?
That's a very good point you raised, Shreeya. As you can imagine, interest rates underpin a significant number of contracts. And generally, when we hear interest rates, we think this is something that the banks need to deal with. But the reality is the counterparty to contracts with the banks is primarily your non-financial service entities, which means that as a company, you will be impacted in some shape or form by the transition from JIBAR to Zaronia. So if I just think about, in our experience, the number of contracts that we see linked to JIBAR will range from your loan agreements, your lease agreements, your derivative contracts, such as your interest rate swaps. And these interest rate swaps might be in hedging relationships. And if you have these contracts which currently reference JIBAR in them, you are going to have to amend those contracts to change that to an alternative replacement rate, which in this case would be Zaronia. And even if you don't have any of the contracts that I have now mentioned, you might very well be doing some type of a fair value calculation, and that fair value calculation might reference JIBAR in it for impairment purposes or just your normal fair value measurements. So as you can see, the impact of this is quite wide-ranging.
That's a very fascinating point that you just mentioned. So in addition to looking at those physical contracts within the desk, we need to think about those valuation models as well that might be using JIBAR as a critical input into their calculations. So let's take this conversation a step further, Nitassha. We've spoken about what's happening in the economic climate. What should we be thinking about when we put our accounting hats on when it comes to this topic?
Okay, so we mentioned the large number of contracts that will be impacted as a result of the reform. Now, generally, all of these changes is going to result in some change required to a contract, because if you've got a contract that currently references JIBAR, that contract is going to need to make provision for Zaronia to be the rate going forward or some other replacement rate going forward. And that's going to result in a contract modification. Now, generally, in accounting terms, the moment you have a contract modification, we've got guidance in accounting standards that tells you what to do with a modification. And that results in some gain or loss in your income statement, which might give rise to some unwarranted volatility in profit or loss, which you might not want there. So as a result, the International Accounting Standards Board undertook a project to make amendments to the accounting standards to give some relief to companies who are changing their contracts simply because of IBOR reform. And these are what we call the Phase 1 and Phase 2 amendments. Now, both of these amendments are effective already. So if companies are amending contracts, they can use these amendments and qualify for those reliefs. So that's important to note. Now, when I talk Phase 1 amendments, these amendments mostly focus around your hedging relationships. Because you can imagine if you've got a hedging relationship that references JIBAR at the moment, and the complexity and how rigid the hedging rules are, you might fail a lot of your hedging relationships at the moment because you are not sure at the point in future when this contract matures whether JIBAR is the rate at that point or Zaronia is the rate at that point. So a lot of reliefs put into the amendments was to still enable companies to continue with hedge accounting, even though there is this uncertainty in the interim as to what that interest rate will be at that point in future. What's important to note is that the Phase 1 amendments will only be applicable during this period of uncertainty. Then we've got the Phase 2 amendments. Now, the Phase 2 amendments is primarily focused on, well, it has some hedging reliefs in it, but its primary focus is around amending contracts. So I mentioned like all companies might need to amend contracts to bring in the alternative reference rate instead of JIBAR. So what Phase 2 allows that if I am amending my contract and the sole purpose for amending the contract is because of IBOR reform, I can qualify for a relief. And what does that relief mean? Well, that means that instead of getting that volatility through profit or loss in the form of a gain or loss from the modification, you will now be allowed to treat that change just as a change in an interest rate. And as a result, there is no gains or losses that you take to the income statement. So that reduces then the volatility that would have been there if these reliefs were not put in place.
Thanks, Nitassha, for that overview from an accounting element. We've covered a lot in this episode. We've considered global and local interest rate reform as well as the potential accounting implications thereof. For once, accounting is saving the day by creating an easier path for entities to practically enable their transition to the new reference rate. Any final practical tips for our viewers, Nitassha, to wrap up this episode?
Okay, thanks, Shreeya. I guess the last closing comments from my side would be there is a lot of disclosure that goes with the reliefs. So be on the lookout for those, and I guess be prepared to present those disclosures most likely for your December 2024 year ends. I think the other important point for me is the reliefs are meant to be reliefs, and as a result, there's criteria that need to be applied before you apply the reliefs. So be careful of contracts that you are amending. Make sure that those contracts are solely as a result of IBOR reform, and economically you are in the same position before and after. Otherwise, you are going to have unwarranted economic and accounting consequences. And I think get a good handle on which contracts you have that are linked to JIBAR and understand what needs to change and how that needs to change, because each company is responsible for making sure that they understand those amendments.
Thanks, Nitassha. I think disclosure tends to be so commonly overlooked, so it's quite critical that you brought that point up. Thank you very much. So to wrap up our conversation thus far, identify within your contracts if you have exposure that will need to be transitioned to Zaronia, and consider whether or not you're in the scope of these amendments that Nitassha just discussed, because there are some very clear-cut criteria that you need to fall into in order to take advantage of these accounting reliefs. Thank you so much for joining us today on Boardroom Forum Live, Nitassha.
Thanks, Shreeya.
Tune into our next episode on Boardroom Forum Live, where we talk about a new accounting standard, IFRS 18, and reimagine the financial statements of the future.